Natural gas futures pushed higher early Wednesday as traders reacted to a fresh round of overnight weather models that swung noticeably colder for mid-December. The shift in temperature expectations was enough to jolt the market back to life after Tuesday's slump, when warmer midday forecasts knocked more than 8 cents off the front-month contract. In overnight trading, prices snapped back quickly, briefly testing resistance near $4.95 before encountering selling pressure just below the psychologically important $5 mark. The renewed cold signal, most prominent in the December 12-14 window, helped unwind a large portion of Tuesday's losses and revived expectations for firm heating demand as the month progresses. Tuesday's pullback had been driven by model updates hinting at warmer conditions across the east and south during the same period, but the latest data has tilted the balance back toward a more seasonally supportive outlook. On the demand side, fundamentals remain robust. U.S. consumption climbed to 114.8 billion cubic feet per day on Tuesday, a 1.5% year-on-year increase. Persistent cold systems tracking across the northern tier of the country are expected to keep national gas demand elevated through at least December 9. The east should experience a mix of mild and chilly spells, while the west and south trend on the warmer side, but overall usage is projected to stay strong, only easing slightly into a moderate high range as the pattern evolves. At the same time, production continues to provide a formidable counterweight to weather-driven rallies. U.S. dry gas output reached 112.7 billion cubic feet per day on Tuesday, up an impressive 7.5% from a year ago and lingering near all-time highs. The supply backdrop is further reinforced by an uptick in drilling activity, with active gas rigs rising by 3 last week to 130, a new 2-year high that underscores producers' confidence and the market's long-term supply resilience. Meanwhile, traders are largely brushing off expectations for a bearish storage report tomorrow, attributing it to last week's milder weather. The market is instead focused on the next 3 reports, which are projected to deliver notably bullish draws, making the near-term softness far less relevant to current positioning. Meanwhile, European gas prices offer little justification for the optimism driving the U.S. market. TTF is hovering near record lows around €28, a level that underscores how oversupplied the global market remains. If U.S. bullish sentiment eventually cools, and it will, the resulting correction could be sharp and unforgiving. For now, the 200-day moving average at $4.73 is acting as a solid layer of support, with additional downside markers sitting at $4.60 and $4.50 should sentiment weaken and selling pressure return. Given the recent turn toward colder forecasts, firm near-term demand, and the market's ability to hold its ground despite record-level production, the near-term bias still tilts bullish. If the midday data preserves, or even intensifies, the colder pattern into mid-December, the path toward a renewed test of $5.10 remains well supported by both seasonal fundamentals and improving technical structure. However, if that colder momentum fails to hold, a mild retreat toward the $4.80 support zone becomes the more probable near-term scenario. If you enjoyed the video, drop a comment, hit like, and consider supporting the channel. It really helps keep things moving.